Welcome back to another video, guys. Today I'm going to be going over my top 5 investments right now that I really like. Most of these are companies, some of these are not companies, but these are my top 5 things that I am investing in right now, and I love these because they are just so stable, they have great returns, and they are just almost risk-free in my personal opinion. I'm not a financial advisor though, so do your own research. Let's get right into it. On our list is BRK.B or Berkshire Hathaway. This is currently priced at $210.45. Over the past 5 years, we have a 62.33% growth. Over the past year, a 1.12% growth. Now, this is not insane, but this is just a great company to have in your portfolio if you're just trying to bring that risk down. Its PE ratio is at 26.67, so not too high, not too low, just right at where it is right now compared to the market. Now, if you don't know what this company is, this is basically the big stock tycoon Warren Buffett's company. If you don't know who Warren Buffett is, this man is a genius. He's considered the almighty god of stock market. He made a name for himself for being in the top, I think, 10 wealthiest people, and he owns the company Berkshire Hathaway. They do a lot of investing, and they own a lot of subsidiaries. Next, getting into their debt to equity ratio, they currently have no debt, so that's great, just money from then on. Coming into their earnings, nothing very impressive. It is an investment company, so don't expect too much in here, but as you see, revenue is up, cash flow is still positive, and EPS is kind of all over the place. Nothing to worry too much about. Their probability of bankruptcy, though, this is where it gets amazing, it's 1%. Now, this is almost unheard of. Most companies have around 50-63%, depending on the sector, but a lot of these companies have a fairly high probability of bankruptcy compared to Berkshire Hathaway with the 1%, so you're almost sure that this company is not going bankrupt anytime soon. Next is Walmart. If you don't know what this is the biggest company in the world. Ticker symbol WMT, currently priced at $137.27. Now, I love this company because, first off, they are the biggest company. They are amazingly well established in the US. They basically are a big company that just sells everything. They are in the consumer staples sector, so they are here no matter what. They're not going to go away anytime soon. During recessions, these are some of the businesses that actually survive and tend to do fairly well during recessions because they're just companies that are needed. Nobody can avoid coming to Walmart and buying stuff. That's where most people go to buy their groceries, buy their clothes. They just get everything from here. Now, over the past year, the growth is 15.87%. Past 5 years, 115.22%. PE ratio is at 25, so not too high. And as you can see, very, very healthy growth. Nothing crazy, no compound-looking growth like Tesla. This is just very stable, healthy growth. Now, if you don't know, this company also recently was involved with Microsoft in a potential buy for TikTok. So they are expanding every day. They're finding new ways to grow their business. They aren't like most companies where they stick where they're comfortable. This company is going to go look for new ways to actually attract new customers and find a new market to establish itself and just grow overall its profits without taking too much risk, since they just have so much money and so much opportunity. If you don't know this, but Walmart recently has been doing a lot of e-commerce, and they actually established their own e-commerce store. They're online right now, and they're doing similar things to Amazon where people can go on there and sell their own products. So they are keeping up to date with the current situation in our world and current market, so they're not going to get outdated anytime soon. It's just an amazing company in my opinion. Getting into their debt to equity ratio, nothing too crazy, staying under 1, which is just perfect. That means they have more actual shareholders equity than long-term debt, so the business overall is good. They're not over flooded with debt. Currently it's at 0.56. Usually people look for under 2. I like to keep mine under 1 when I'm investing long-term, just to be extra safe. Now, the EPS is up by 0.9% over the annualized 5-year growth rate. Nothing too crazy, but keep in mind these guys are dealing with billions and billions of dollars, just insane amount of money. So even though 0.9% might not seem like a lot, it is a huge amount of money, and it's just hard to get insane growth or insane new amounts of money every year when you're dealing with just so much money. Revenue is up by 1.5%. Cash flow is up by 0.2%. Now, moving on, Walmart's probability of bankruptcy is only at 8%. Now, it's doing amazing. It's outcompeting its other opponents. Walmart's probability of bankruptcy is 8%. This is 77.89%. That's an insane number, lower than the consumer defensive sector at 61.39%, lower than the discount stores industry. So as you can see, they are at the top of the line. They're just doing amazing financial wise, so it's just a great investment long term in my opinion. Next on our list is McDonald's Corporation, or ticker symbol MCD. It's currently priced at 218.18. Its P ratio is on the higher side at 37.42%, but I'm not too worried about that because, as you can see, very healthy growth. Over the past 5 years, we've got 123.57% growth. Over the past year, 2.61% growth. Now, if you don't know what this company is, they're the second biggest restaurant chain in the world. Number one is Subway, but sadly you can't invest in Subway. They are owned by a private company, so this is your opportunity to own part of the biggest publicly traded restaurant chain in the world. Honestly, I don't think they're going anywhere. They've got stores everywhere that you can think of. In some countries that you probably haven't even heard of, they are there. Now, McDonald's debt to equity ratio is negative at negative 3.66. Now, usually negative is bad because that means they have more debt than they can actually pay off, meaning that their shareholders' equity is negative. So this usually is a bad sign. It means that their debt is not bringing in enough money to cover that debt. So usually this is a horrible sign, but do not be worried because in McDonald's case, or Home Depot, which is next on the list, these companies are actually doing stock buybacks, and they've spent about $20 billion in stock buybacks in the past couple years. And this is basically when a company goes and buys their own stock back. This is nothing bad. This basically just means that the company thinks its stock is undervalued and that they're getting it at a good price, and they also want to allow some support. Usually companies will do this during recessions or times just to give their stock price an extra oomph and extra support in case anything bad can happen. So it's nothing bad at all, nothing to be worried about. This just means that they're buying their stock back because themselves want some of that sweet gains and sweet tendies. So getting into their earnings, their annualized 5-year growth rate for EPS is up by 10.5%, so great growth. Their revenue is down by 5.1%. Nothing to be worried about. I'm not too worried. Their cash flow is going up and their EPS is going up, so that's just great news. Their cash flow is up by 3.7%, and their actual percent of bankruptcy is only at 15%. And like most of these companies, they're outcompeting their own industry, and the bankruptcy percent of 15%, this is 63.76% lower than the consumer cyclical sector and 54.32% lower than the restaurant industry. So that's insane. It's outcompeting all of its competitors, so that's just great to see. Very solid company overall. Next, we have Home Depot. Over the past year, we've got 17.73% growth. Over the past 5 years, 130.04%. Now, ticker symbol HD, price currently at $268.55. Its P ratio is only 23, so not too overpriced, not too undervalued, just where it should be. And decent growth overall. I honestly love this company. I own most of these, almost all of these actually, but getting into the debt to equity ratio, as I said earlier, this is the other company that has a negative debt to equity ratio, but I wouldn't be too worried about it because although it is negative 78.19, they are a cash cow, so they got insane amounts of cash. So although they have lots of debt, don't worry about it, they can pay it off. And as McDonald's, as I said, they're doing stock buybacks, so it's giving them a negative equity, so nothing to worry about at all. Honestly, it's just a great company overall. Now, getting into its earnings, the earnings per share is up by 16.8%, revenue up by 5.8%, and cash flows up by 10.7%. So great growth overall. Companies bringing in more money every year, so that's amazing to see. It's not staying stagnant, it's growing. Its chance of bankruptcy is only at 5%. That's just beautiful. I love this when I'm investing long term, so this is why I'm choosing these companies. This is 87.92% lower than the consumer cyclical sector, and it's the probability of bankruptcy for all United States stocks is 87.45% higher than this company. So honestly, I'm just flabbergasted by this. Just an amazing company. As you can see, its probability of bankruptcy is just insanely low. Now, next, this is the lowest risk investment in my opinion. These are actually bond ETFs. Berkshire is the second lowest on this list. Now, although I guess this is almost cheating stock-wise, but it's still good to keep in here when investing long-term. Bond ETFs are something to have. Now, usually these don't give a good return at all. You're usually looking at 1% to maybe 3%. This is because you're basically loaning out, and interest rates are not going to be high. They're not going to be giving you 100% return every year. So as you can see, over the past 10 years, your money would have grown to $13,453. Nothing crazy. And on this one, your money would have grown to $12,000 to $13,000 in the past 5 years. So nothing crazy, but these are two bond ETFs that I'm showing you. One of them is Vanguard, one of them is iShares. Now, this one is a high yield corporate bond ETF. Their current yield is at around 5% if I'm not mistaken, and their expense ratio is not too high at 0.49%. It's not great, but it's not insanely high compared to the return you're going to be getting on your investment. So as you can see, the average yield to maturity is 5.58%. 12-month trailing yield is 5.07%. This is basically what you're going to be getting paid out in form of dividend payouts. Basically, these are the safest investment when it comes to stock market, because as I said, you're loaning money out and businesses are paying you back in interest. Now, the only downside with this one is it's a little bit more risky because bonds can default, which means the business is not able to pay back that money. And the reason this is such a high yield is because it's going for those riskier businesses that have a higher chance of going bankrupt or that need more money because they are in bad financial situations, and most likely you don't always pay back their bonds. So that's why the yield is so high, because you're taking on much more risk. And that's why I put this Vanguard short-term corporate bond ETF as well as an option. This is much lower risk. Vanguard currently puts it at a 1 for risk-wise, and the iShare one is currently called HYG. The VCSH one is the Vanguard short-term corporate bond ETF. This one has an expense ratio of 0.05%. So this is just insanely low. As you can see, the risk level on this is 1. So that's great. Very low risk. However, since it's such a low risk, as I said, you're not going to be getting crazy amounts of money back. Honestly, I would put this, but usually this is where stuff that people invest in more when they're getting to much older age. And these are short-term bonds, which basically means they have a higher chance of giving back more, because usually in bonds you want the shorter bond possible, because long-term bonds, the interest rate can fluctuate, meaning you're not always going to get a good return. With the yield to maturity on this one is about 1%. So as I said, it's nothing crazy, but it is extremely low risk. So yeah, those are two options. Honestly, I'm not too heavy in these because I am younger. Once I get towards the age of 30 or 50, maybe I'll start investing more towards bonds. But right now, I'm currently sticking with index funds for the lower risk investments, and these companies as I showed here. So thanks for watching, guys. I hope you enjoyed the video. Hopefully this helped you out. If not, give it a dislike. It helps me know if I'm doing something bad on my video. And if you do leave a dislike, please leave in the comments down below what I can help, because I just want to make these videos better for you guys. I hope I can earn your subscription with this. But yeah, thanks for watching, guys. Have a great day or night.